So let's go ahead and kick off this Waxhaw Board of Commissioners work session for this August 25th, 2026. Before we kick things off, we'll have a brief moment of silence to honor the passing of one beloved Dolly Parton. Thank you very much. The legends live on. Alrighty, so we'll go ahead and kick this off. We have a fairly short agenda, but I will ask if there are any adjustments or amendments to tonight's agenda. Hearing none then, can I get a motion to adopt our agenda?
So moved.
All in favor?
Aye. Aye.
Agenda is now adopted. So our first order of business is a presentation regarding our capital planning for FY27.
Okay. I'm going to do an overview of both my presentation and Mitch's. It kind of bridges it and brings everybody back up to speed. So I need to put up the is it C1?
C1. Mm-hmm.
C1, please. That one. Yep. Thank you. Okay, so just to kind of bridge, you will also have a copy of this presentation that will be on your computer at a time too. But this is just a little, gives us a bridge between two different things. I'm talking, I have a memo that was part of the agenda that's about cash flow, cash position, where we are as far as we know where the dollars are in the bank and what the next 6 months look like. And then we have our friends from Davenport, our partners who have helped us on in the financial analyst role and helped us through prior debt structures to understand both how the outside world looks at us and what our position is from a third-party perspective. So we're glad to have them here tonight to talk about that. So go to the next one. No, I don't know. Oh, maybe I need to turn it on. Yeah, that would help. Okay, so the purpose of tonight's work session with regards to the two subject matters that we're going to talk to you about is trying to give a clear, shared picture of what the town's current and future cash position are, what the fund balances we predict might be, and tax rates and the mix of savings, revenue, and financing tools to sustain two different aspects of your budget. One is both operations and the other is capital investment over the next 5 to 7 years. So we wanted to build a bit of a shared baseline with you folks. We had a meeting at our last work session last month, but this conversation continues. So we're going to dive in a little deeper every time so that the board feels comfortable, ask the questions you need to, and has the discussions that you need to as we move forward. So we want to ground the board in those current state of facts where we are. We want to frame the trade-offs as we move forward. It's always a trade-off between scarce resources. You know, do you do this? Do you go this way? Do you build this? Do you not build that? You know, lots of decision points as you move forward. What's the best use of a dollar? What's the most strategic position that we can be in? What is our current growth rate? Where are we? How are we moving forward? So the board's done a lot of work on looking at the 5-year CIP from a planning perspective. You last year did a lot of work putting together ordinances and segregating dollars and committing them and reserving them in various positions within your savings accounts for projects. So the board's been doing a lot of this work for last year. Now we're in the new fiscal year, and you adopted a ordinance for capital and an ordinance for operating. So now we're going to dive even deeper into the ordinance on capital. My part tonight is really going to talk about operating because that's one piece of the puzzle. Davenport's going to give us an outsider's view and, as I said, a third-party view of the way we look and how the crediting agencies might look if we decide to go in that direction. So 2 presentations, 1 financial picture. As I said, Davenport Public Finance, who has been our financial advisor since 2017, Going to talk about credit rating, standing and peer comparatives, general fund operations, fund balance trends, existing tax-supported debt profiles, and that's the capacity you have within your structure. As we move forward, it should be noted that 5-year is a comfortable number moving forward. The way things are right now, anybody watching the bond market and several other things, 2 years becomes the more comfortable position, and less than that can sometimes be the reality, watching those markets. 10 years, 2 years, long range 30 years, and how the market is responding in general. My report's going to talk about the 6-month cash flow scenario, so it's going to give you a real in-time analysis of where we are with capital projects for the next 6 months and how we draw those monies down and how we manage those resources as we move forward in what is the lowest period of time for collection of revenues, our lowest time, and it troughs mostly around November because we don't receive our large installments of tax revenue until December and then really into January. So we're going to talk about how those funds work and those timing of those things and how staff views a working liquidity target versus an adopted reserve policy. We'll go into some of that. So we want to go back again, as we're trying to do with everything we present to you folks, we're trying to present it back against your goals. So we're trying to make sure that we're reminding ourselves of what you wanted to get done not only this year, but how you see things moving forward. So we're trying to tie it back. One, infrastructure. We were very clear about proactively managing and expanding that capacity while maintaining our small town feel. Growth management, fostering sustainable development that balances residential growth with commercial diversification, diversifies that tax base, does the things that you folks want it to do, that both serves internally and creates greater balance. Economic sustainability, building a long-term fiscal resilience, and that's really what we're going to talk about tonight, is trying to help build that long-term fiscal resilience. And then lastly, organizational development, how we keep up those operating so that we continue to operate in people, culture, and tools that help us serve the citizens of Waxhaw and work with our partners and do the things we're supposed to do to maintain the assets that we are bestowed with and are charged with keeping up with. So there's really, as I see it, 4 questions the board is weighing as it goes through this process. Operations, how do we maintain and improve operational service delivery over the next 5 to 7? As we know, since 2020, things have had an inflationary punch to them, and that hasn't gone away. So we're 6 years away from that. We're still dealing with inflation, the cost of things, the cost of people, the cost of materials and supplies, all those kinds of things. So, maintaining that straight line and what do we do and how do we serve people. So that comes out of operations. 2, capital investment. You folks have directed very clearly, we have a transportation master plan, we have a parks master plan, we have a downtown master plan, we have lots of master plans, we have development ordinances, we have reserve positions we've developed. How do we invest back into the community so that we can get around, play, make sure the assets are up to speed and everything else? And how do we finance that? How do we sequence that and how do we finance that? 3rd, revenue and costs. What do the revenues, and this is where we're going to talk about taxes and growth. You're going to see this referred to in here. This is not implied that you have made a decision. This is, what does it look like? On both taxes and growth and the cost of doing both, what do they look like? How do they affect both your savings and your investments and your financing as well as your operationals? And then finally, the financial structure, tax rates, cash balances, growth assumptions to make lots of this stuff work. We've had a very high level, I would say, over the last 10 years, although for the last 2 it's tapered in growth. Rather sharp spikes compared to where we were for the 10 years previous to that. That rise in timing with COVID dollars, things like ARPA, state directed dollars from the legislature, in building this place, and those proceeds, those bond proceeds coming into this, and how they affect our cash position, and where are we now. So mine is going to really deal with operational sustainability, and that is what we call the rate question. So how do you, over 5 years, what does that rate have to be, tax rate we're talking about right now, in order to sustain within a series of scenarios? Explosive growth, no growth, and somewhere in between. As you can imagine, doing some scenario model, we're trying to figure out our extremes and then picking some line down the middle. Now, as we were chit-chatting a little bit before the meeting started, getting to the ability to predict past 2 years in the markets right now is getting harder. It's a real task just to get to 2. To get to 5 is a climb. 5 used to be a standard, but things are a little bit unpredictable right now with regards to rates and inflation and some of those things. So there's a lot to talk about and a lot going on. So these are what the numbers say. If you never grew, if you didn't add, you would have a catch-up point at the end of your 5 to 7 year range to make up for the money you took out of your savings account to pay for things, had to make up in the rate and the rising cost of just baseline operations. You can see that that's a very extreme number. Now, it's meant to do that to you. It's meant to show you an extreme position in this. So remember that we're already in a budget that says that we have 807 in what we would call a deficit position. We're pulling from fund balance. We haven't issued, we have started at the end of June issuing building permits, but we had a 6-month, 7-month drought. So we had to pull from their reserves, which we can only use their reserves for them. That's the way the state statutes work. So you have a structural gap of about 1.72 if you just look at that. So 1.72 cents, around 2 cents. Now that number probably makes sense to you folks if you were doing the math through the budget process. Those numbers probably make some sense. So, if you had a magic wand and you could just make things happen, a modest proactive rate increase of about 149 now on your 29 cent would hold you steady over time and let you be at around 40%, 30 to 40% in cash on hand at the end of a 5-year run. That's if everything went fine and growth happened and there was some steadiness down the middle. But we have to play stress scenarios with you folks to help you understand how we see the next 5 to 7 years and how you need to see the next 5 to 7 years. So in my last memo to you last month, we talk about a couple of things. We talk about how do you finance capital investment. We play about all these games in one way or another. So grants, we are receiving, you recall a presentation by Engineering and Traffic when they showed you the amount of CARPO dollars and federal dollars that come in against the amount that we're paying against. Our amount's around 10 million, and that's leveraging somewhere in the neighborhood of around 200 million in cost structures for various projects around town. 10 million being our portion and the rest of it being from other financing sources, mostly the state and the feds, as well as developers. So you have grants, you have pay-go as an option. You just draw, you take your money out of your savings account. You have GO bonds, which is the best one if you're going to borrow because it gives you the most flexibility because the voters have to vote for something like that. So if the voters say, yes, you can do that, then the people who lend you money like that and they give you the best rate because it's not secured. It's secured by the voters. It's secured by the tax rate. It's the voters said, yes, I want it. And that security in the markets for public finance is the strongest one. So it gets you the best rate, it gives you the best terms. Hopefully, you negotiate the best terms and do all of that. But
That covers unsecured and secured properties.
that, and that's the other trick. 10 million of what we're spending over the next 5 years or so are on assets we do not own. They're owned by the state of North Carolina, or, you know, they're not ours. So we can't collateralize it like I would the building. I can't collateralize it against a vehicle. I have to do that. So that's an installment financing that does that. It has a little bit of a peculiarity in the installment. It's not always necessarily collateralized. For example, we're doing the police cars. They'll collateralize them, but they're ours. They'll title them to us the minute we get them, for example. But at the end of the term, it's 3 years on the police cars, we'll pay $1, and then they're ours all full title. If anything weird happens, they'll come back after something. But again, we're still guaranteeing as a government we can cover that installment. Same with the building here. So then that's the installment financing thing. And then there are revenue bonds, but we don't have anything that produces a revenue. So we don't have a water system, sewer system. Toll system would be a revenue bond. So the State Turnpike Authority would do revenue bonds on things like that. So when I talk about the 6-month cash position fund outlook, I'm trying to let you know that between July 1st and December 31st is the first 6 months, or the first half of our fiscal year, are our tightest. They are our tightest because we receive the majority of our money between the end of December all the way through March. And that's when we are at our highest level of cash on hand. Now, because folks will listen to this and want to make sure we understand, there's a difference between our cash in the bank and our funds. Our funds are how we categorize our money. So we say, I have $1 in the bank, and of that, 50 cents is for this, 20 cents is for this, 30 cents is for something else. But I still have $1 in the bank. And our objective as we move along is that we want to have at least $5 in the bank, that we can go to the bank and say, I need to draw down $1 because I got to make payroll this week. I'm being very overly simplistic about it for a reason. I may have $10 actually in the bank, but $5 I'm going to put into something like a money market where I can't pull it out without penalty. The way I maximize 3.5%, 4%, 3%, 3.09 is by keeping it there and never touching it. So I have a liquid amount of money that I need, and then I have that's invested. Now, in our particular case in North Carolina, we cannot be so long on investments that we can't go get it. North Carolina likes a local government to be liquid. And it likes that ability, when Helene comes through, for your ability to draw those down and make your payroll and pay for things and do things over time. So our cash position, though, we do try to manage it. So on a monthly basis, actually on a weekly basis, we're receiving receivables, and we are putting money where we are either liquid. We have a couple of accounts that we do that. You'll see those charts in the financials. That we try to remain very liquid. That's where we go get the $1 out, pay the $1. And then we have other accounts that we're trying to keep it in there and earn some interest and earn some money. So if we do not plan it well and we have to go to that other money, that affects us because, as the board knows, one of your revenue sources is interest off investments. That counts for about 2 cents every year. We may budget it at around $500,000. We predict we usually make about $1 million. That covers that shortfall in fund balance. That's that little bit of a game that you play, but it's also an ability to take care of things if you have to. So, because you've said, yeah, we'll spend it if we have to, or we'll take it from that savings account. So, we receive monies from 2 different places. The state, because we receive receivables back in sales tax, franchise, ABC liquor, some of those things, and our share of those taxes that come back, as well as The only one we get on a monthly basis is from DMV because people go in and pay their tags. So we get two different sources for that. We get the personal property tax that one pays on a car. So the property tax you would pay on your vehicle, because everybody's different. Everybody goes into the DMV, pays on a different month. So that's a monthly thing, but that's the only monthly thing we really get. Other than that, we're getting it quarterly, and the state's always 1 quarter behind. So we did finally get our sales tax in from fiscal year 26, our last one. So, but we plan for that. We know that. And so we manage our cash flow accordingly. Again, however, in July, August, September, these are our lower points and they go down. We have an outflow on average of about 1.5 for operations, and then we have one-time payments we might make over that time. So smoothing it, we're about $2 million a month out. We pay a debt payment one time in August, or we might pay other things one time like workers' comp or something like that. So we pay chunky things over that period of time, but smooth, it's about $2 million of outflow per month. But we have to manage our cash to make sure that we have funds available in the banks so we can make those payments, we can do those things, and they're recovering. And then it keeps us from having to go to our more secured accounts, the accounts that make you a little bit more interest and thus make that work for you. So hopefully tonight should be a good discussion on a shared understanding of the current fund balance, debt profile, and near-term liquidity positions. I don't want you to hit some of these questions possibly until after you hear Davenport and you get some of those questions answered. It may be easier to come back to this, but nonetheless, can I answer any questions right now?
The chart you showed before with the, extreme tax rates on it, that would be the pay-go scenario, right?
This one here,
Yeah. So what this chart does, and that's why I say don't overreact to it. This is a representation of what happens. That 149 represents an evening. You're short 1.72 right now. If you have a rate and you could do it right now, you're short about that much just on the operating side of your balance sheet. In order to preserve your cash position at around 30 to 40% of fund balance, you'd have to have that relative over the entire time, knowing full well that in 29 you have a reassessment, knowing full time you may have growth, you may have explosive growth, you may have no growth. We have 1.14% this year. I don't think we're going to hit anything much above 1.14 again. We don't have enough COs coming in between now and December. We may, but last year we added $72 million to a $4.6 billion valuation. That's what you added, $72 million last year, and so you've had some slower years. So your growth isn't exactly there.
When you
That
say
can change
growth, do you mean growth in revenue specifically?
Growth in revenues and value.
Right.
Right. The value on your baseline for that. Yes, sir.
And then what is meant by historic run rate? What are you trying to communicate with that?
What I'm trying to communicate is if you were drawing down your cash, you had, you went by your historical thing, but you were spending your cash against future cost. Your rate at year 5, you'd have to raise it that much to make up for the hole that you have, because you'd go below your 30%. You'd probably go closer to 8 in your cash position. So what that's trying to reflect is I took all my money out of the savings account, I bought the car, I may not have a car payment, but I took all my savings to get there.
So what you're suggesting then is the 1698 is, for lack of a better term, the cost of inaction, given our current spend rate.
Yep.
And all our financial commitments.
Yep.
If we do nothing, then
Yep.
in 5 years, we're looking at that kind of increase.
That's if you pay-goed your all of your capital and you didn't do anything with your rate about the rising cost over 5 years. Because your growth model is that it's taking that low run. So
Now, is
go ahead.
sorry to quibble over it, but I just want to make sure that we're all clear on what the 17 cents means. So is that 1698 is what's needed then to get the reserve back to the 30%?
Yep.
Okay,
And to meet
so-
your ongoing operation.
So over the course of 5 years, your reserve has dropped, I think you said 8%.
It drops.
To 8%. And in order to get it in 1 year, back up to 30.
Right, but that's if
It's
you
gonna require-
spend everything out of your fund
Yeah.
balance. That's
Out of
not-
fund balance, exactly.
Yeah.
You're spending money out of your savings.
And that's what I'm
Right.
getting at,
Yeah.
is
Yeah.
the point that I'm trying to make is that this graph is illustrating, again, the cost of inaction, just doing nothing and steady as she goes, no adjustments to rates, and we keep investing in all these CIP projects, which are traffic projects, unfortunately, but we keep investing in all those projects. With all those spends, our reserve gets to 8%, and then in order to get it to 30% in one fell swoop, it would be 16.9.
You'd have to do that.
Right.
Yeah, and then, you battle with, you need growth, but all the residential growth that's been approved for all these years has put us in a position where we have to, we need more services.
All these
And
traffic updates.
so, and the traffic, and the developers do some traffic mitigation, but it doesn't really solve the problem, so then we have to add millions of dollars to road improvements, which are necessary to keep people safe, so
Yeah.
we need to also, as a board and boards moving forward, look at that commercial residential rate and be very careful on what we're seeking to bring to town. So if we have a developer that is out there, let's let them know what we want, rather than let's just take what you're giving us kind of thing.
Yeah.
Which many years ago may have been like there was nothing here, right? So no one could foresee 25 years ago what Millbridge, approving Millbridge,
Would do.
what that would look
Yeah.
like. And then in the last 5 years, all the other approvals that now there's dirt moving, but we don't know
Right.
when they're going to go vertical. And so we are still paying for all that.
Right.
So I think we need just to look at it as a whole.
And remember,
the scenario here is also what we're looking to get away from by looking at the go bond or mixed option, so that
Right.
we are not suffering opportunity cost of these valleys that you're talking
Right.
about in our revenue throughout the year. The opportunity cost being that we can't invest in longer-term funds that have a higher interest rate and increase our
Right.
investment income.
that and just against the rising cost of doing business. So your operation, I'm just giving you on the operational side. We're going to talk about the capital side, but the two are in tandem. You only really have one fund, 120, and then you have a reserve fund. And, I mean, those are the two funds. You don't have an enterprise fund. You don't have other funds that cash flow over time or through the year. You just don't have it. You don't have a utility. But there's also a lot of nuance to this over time too. All I can do is build a scenario model. I can't tell you if that's exactly what will happen. We're doing our best guess right now, and part of this exercise and why you get the financials the way you do on a monthly basis is so that you're tracking them. So you're seeing them, you see where your investments are. When we give them to you, we actually give them to you by fund, and at the bottom we give them to you by bank account. We let you know where the dips are. We let you know what the outflows are and what the inflows are during any given time, and what's making it go differently. So my analysis now goes into when we got to this budget year. Where's Rosie? In her favorite chair. So Rosie and I, the budget gets adopted, and simultaneously we walk back into the office and go, that's a lot of capital drawdown on cash. What does that look like? And so staff began working on some options, and that's what I need to go to next.
Scott, before you switch that slide,
Yes, sir.
we have a state obligation to keep a fixed amount, a minimum base. For the residents listening, what is that fixed state mandated?
So there are two numbers that the state statutes deal with. One is 8%, and that's 1 month's worth of operating. The second is a what's called a rate stabilization amount. And so there was a period where a lot of local governments in North Carolina did not have even the 8, let alone what would be best business practices and the best practices against how you manage your business. So our number's probably more around 20 at that. But what I would say is that this board, previous boards and this board, because you do it in your budget year, we have a series of financial policies that say 30%. Now, 30% is more or less 3 months worth of operating funds if Helene came through again. So that's why you have it. Helene's the perfect example of what happens and why you have a fund balance in North Carolina. And management's position is, I like 40. Why? Because that's 4 months worth of operating. But I also like it for another reason. I do not have a monthly inflow that either matches, closely matches, or exceeds my outflows. Because I don't have that, we have to manage our cash a little differently so that we have an amount larger than that. And the town is blessed with that. Davenport's going to talk about, Mitch and his crew are going to talk a little bit about what we look like in that mix right now. Good stewardship. We do have money in the bank. We're fortunate. But when I woke up after the budget was done, it was like, how do I expend? So the next, it's only 3 slides, but the memo that I sent out to you folks on looking at the first 6 months cash flow was, where do our fund balances go to? Where does our cash position go to if all of a sudden magically you add $3 more million worth of outflow? And it scared us a bit because it dips not so much the fund balance numbers down, but it hurts and makes it harder to manage my cash on hand. Because I have more going out now than I have coming in. I haven't recovered it yet. Now I have to pull it from other accounts that will now affect another revenue number, and that's the investment number that you have in your general fund 120. And so we asked staff to put their best thinking cap on. This is really out of the project groups, engineering, who are doing a lot of that work, and said, split yours out. Let us know about your top 3 projects, Kensington, Pine Oak, and the paving. So in what I sent out to you, can we go to the next section, please? The next PowerPoint should be, yeah, there you go. Thank you. So what we were concerned about, and this gives Commissioner Daunt a little bit better flavor about what's going on here. The orange is outflow. And it's larger than inflow up until about December. That's the story. You're taking more out of there than you're taking in. So that's where we have been trying to model the next 6 months out of the current fiscal year. Now we're not talking about abstract things or anything into the future. We're talking about what we're actually doing this year. So by reprogramming how our outflows of cash would work and how we would pay on the projects, and that's on page 2 of the memo that I sent you folks in your packet, what we were able to do is move paving to the spring. We actually might be able to maximize more because we actually might be able to go into the following year, maybe get a better product out of that. But we have more cash on hand at that point in time. Secondly, Kensington, we had them plot out that, and we had them plot out Pine Oak, so that our outflows now will not have a negative effect. If I had lump summed it, I would have been out 3.1 million in 6 months on top of the amount that I'm used to outflowing. So I would have had to find my 3 million in my other accounts. So it's not bad. We're in a good financial position. I want to say that again. We have good stewardship. We have money. We know where it is. We have those things. But you still have to plan how you do these things. And that kind of interruption hurts. The last thing, you know, I've been with organizations. Anyone who's been in the business long enough knows when you can't make payroll. If you run some of your smaller businesses, you know you have months where it gets really tight. Those are realities. The state forces us to have enough money on hand, so we shouldn't do those things. Good cash management puts us in a better position so that we manage our timing of outflows against those things. So that's what we wanted to at least highlight. That's what I wanted to make sure I did in my report out to you of how we saw this. But that's 3 million out of the 6.5 million that you've budgeted this year. Now, I don't think some of these, you guys have watched these. Helms were in design and then we'll go into right-of-way. Those outflows aren't as big. We've budgeted, we have reserves, but their outflows aren't concerning us yet. Once you get to right-of-way and then you get to construction, those are the big worrying years. Because that's a lot of money out the door at one time. So we're a little bit in a benefit with that because some of these are in design. So Broome Street's in design, Kensington's going to construction, paving is real construction, real dollars out, and then Pine Oak is real dollars out because it's real construction now. I mean, it will actually happen between now and December. So we wanted to make sure that we understood where our low points were and our high points were, and the majority we made and pushed out a majority of the bigger payments towards our November, December numbers when we could afford to do that without disturbing the balance of our bank accounts and other things. Stop there for a sec. Questions? Again, that's 3 million more than we're used to flowing out of our accounts in that period of time, which means that there's 3.5 million possibly flowing out in the second half. So we'll start planning on that one after we leave the meeting. But this is where we see your effect. And I wanted you to see this because I think this helps with the next part of the conversation to understand capital, fund balances, rates, and what the board's options are moving forward. Rosie, did I do okay?
You did great.
Thanks. It's like a pat on the back from back there. That's great. Did I miss anything? Anything I need to bring up? Okay. So, again, next time we meet in September, we're going to dive in deeper after you've had this. And because a couple of things that we need from you folks for us is, which direction do you think you want to go in to do all of this? Give us that idea. That solidifies where Davenport and the town need to be, because then we plan better and then we come back to you with different and deeper kinds of information about how to move forward. You'll have, let's say you said to me, no, we're going to pay all cash. Okay, then we know how to strategize that. If you said, no, we want to blend, that's when we put our hats on and we think through what does that mean, how do we schedule it, how do we work it, what's the best strategy for paying for things, how do we do that, how, you know, all of that. If you say GeoBond, you've missed a cycle, you would still have to come back into the following year, I believe in 27, I think would have to be something on that, if you decided to do that. And we're going to talk to you about why GeoBonds, if you're going to finance something, why GeoBonds are good. One, you ask the people. That's always a good thing. There's nothing ever wrong with asking the people, is this okay? And if they say yes to you, you get the best negotiation position that you can have in the cost of money, in the timing of it, and how you schedule it. And the state statutes then allow you to use that to then begin your rolling forward in capitalization. Because if anybody thinks we're going to do all this and be done in 5 years, you're not. You know, there's going to be something else that comes up. There'll be something else that comes up. Been doing this for a while. There's always something that comes up, and it just seems to do that. So you're fighting that tide all the time here. So can I answer any other questions? Because I'd like to turn it over to Mitch with Davenport, who's been a really good partner to work with up to this, and I'm going to turn it over to him. Have you already got your mic on?
You now?
You can come right on up. So if we could go to the last one, please.
Good evening.
Good evening.
Good evening. Getting me called up to the big table. All right, I did make some copies of our presentation too. If anybody doesn't have a hard copy, you're welcome to that. I'm still a paper person as much as I try not to be. Well, thank y'all for having me this evening. You want me to just dive in here, Scott?
Dive right in.
Okay. While those are getting passed out, I'll just let you know what I'm gonna, you want me to take that?
Yeah.
What I'm gonna cover today, and I will warn you on the front end, I get excited about this. I do like what I do. I think it's interesting. If I'm going into too much detail or getting down a side road that's not of interest to you because I'm excited, just call me out. Make this as quick or as long as y'all want it to be, I'll take your lead.
Scott says the same thing. He gets excited.
I did have in here on the front end just a quick introduction. It's been a minute since we've been in front of this board, so I'll give you the elevator speech on what we do just so you got a little bit of background. And then really dive into y'all. And we'll look at you, like Scott was saying, from the credit market's perspective, right? If you want to go and borrow money, how does the credit market going to look at you? And that encompasses fund balance, that encompasses debt, and we'll dig in on the debt side a little bit to think about what does that mean for your future opportunities, challenges, et cetera. And then kind of wrap it up with maybe a little bit of a deeper dive on the financing considerations here in North Carolina. So that's what's coming. Tell me to fast forward or slow down or however you want to do it to get to what you want to talk about. Elevator speech, front end. We are a financial advisor in the public finance world. What that means is we are a fiduciary to you. We are not lending you money. We are not arranging a balance sheet financing for you from our funds. We are sitting on the same side of the table. We have a duty to put our interests behind yours and advise you and give you the information you need to make the best decisions for the town. That is our role. We work for you, and we're not trying to sell you anything or lend you money. And I think that's an important consideration. All this, like I said, we want to be a partner to you in this and do what's the best thing for you. We do this for a lot of folks around the state. We've worked with you all since 2017, done a couple of financings, put together some financing repayment strategies, worked on the CIP a little bit over the years. And that's kind of the work we do around the state. We work with over roughly half the counties and a lot of the cities. So big and small, we kind of see it around the state, and sometimes it's helpful to have that perspective on what's everybody else doing, right? And so we can kind of take pieces from around the state. So that's the elevator speech on who we are. I'm happy to dig in further, but I don't like talking about ourselves, like talking about it. All right, so, sorry, I forgot about that. Okay. I can't do two things at once. All right. Big picture, credit markets. You want to borrow money, right? Take it back to ourselves, right? We want to buy a new house. What do? We go to bank, a mortgage company, we get pre-qualified for a mortgage, and they pre-qualify us for some amount of money. And in order to do that, they pull our credit score and look at our banking history. In the municipal world, the equivalent of pulling that credit score is your credit rating. There are 3 historical, 4 now fairly common national credit rating agencies that do this. You know, it's not Experian or whoever. It is Moody's, Standard & Poor's, Fitch, and the newest one is Kroll, KBRA, who's making some more traction and becoming more commonly used. Summarized for you here, Moody's, S&P, and Fitch. We don't get a score. We don't get a 750 or 720. They're alphanumeric. Alphanumeric, yeah, I said that one right. AAA is the highest. Then AA is the next level. And within AA, you can have notches, right? AA1, AA plus is the highest. AA is the medium. And then AA3, AA minus is the low. And it goes down from there into single A and so on. Anything above that double B rating is going to be called investment grade, right? Reality of it is, in North Carolina, we don't have anybody below the single A category, and there's only one person currently rated in the single A category in terms of cities and towns, a couple counties.
So just to get an understanding then of the rating, nuts and bolts, if you're a AAA versus a AA, what are you really looking at? Is there a substantial difference?
Yeah, in terms of interest rates, you know, in the public markets, which is where you think about municipal bonds, right? That's the public markets varies AAA to AA, maybe 5 to 10 basis points, so 0.05%, 0.1%. You're going from a 4% to a 4.05 or a 4.10. Going from AA to single A, worsening on the credit score, a little bit of wider spread. I mean, 15 to 25 basis points. So 4.05 to a 4.10 to a 4.15 to a 4.25, 4.30. It's not insignificant, but it's not also like going to send you off on a completely different route of a financing.
You're not going from 6% to 8%.
Yeah, it's going to, it will impact your cash flow, and it'll take away some of your cash flow with a little more interest cost, but it's not likely to be the difference between you being able to do a financing and you not being able to do a financing.
Yeah.
That makes sense.
And you might want to balance that based on how much you are borrowing anyway. I mean, you might not even have much debt, right? So
yeah, which you don't. And, you know, we talk about this a lot. I don't think y'all are in this position right now, but, you know, some folks have difficult decisions to make. We've got pick on a fund that you don't have, water and sewer infrastructure. Y'all are probably hearing a lot about it, right? It's a big need around the state and around the country. And a lot of it's driven by need for water and treatment capacity because of growth. A lot of it's driven by regulations, right? You know, the PFAS and the Clean Water Act, and don't have a choice. Got to be done by 2028. So what do? You know, do you double your water and sewer rates to pay for it and maintain your cash balance? Or, you know, do you let your cash balance fall? Do you lower your margins and deal with a lower credit rating, but maybe you don't have to raise rates as much? There's trade-offs in everything that you do. You know, all things being equal, you want to be rated as high as you can. That's going to, A, give you the lowest interest rate. Right. B, it's going to ensure access to the markets, right? The lower rated you are in a tough market, illiquid market, you know, lenders may still lend to the strongest of strong credits, but you get down in that A range and maybe they start thinking twice about lending money because their money is so scarce at that point, right? Yeah. So better interest rates, access to the markets, and there's the pride factor, right? You want to be there. So we typically try to strive for the highest ratings, but also understand that there are trade-offs with it. As we go through here, we're going to show you kind of how some of these rating categories, the medians of these rating categories, stack up to where you all are. And so for perspective, you can see nationally, how many cities and towns are rated in the AAA, the AA generally, so that's A1, AA plus, AA2, AA, AA3, AA minus, grouped together, and then single A, right? So, you know, the majority of folks nationally are falling in that AA rated category, right? And then similarly in North Carolina, you see there's 43 cities and towns that are rated, and over half of them, roughly half of them, are in that AA category. And we've listed out the names for you. I always think that's, folks find that interesting to see where everyone's rated.
North Carolina's doing pretty good then.
North Carolina is doing very well. It's always been a highly rated state, highly regarded state in the capital markets, for sure. You all are not rated right now, and I probably should have led with that, but you haven't needed to be rated, right? Because the only time you actually need a credit rating is when you're selling bonds in the public markets, when you're selling municipal bonds. Talked about GO bonds, right? That's kind of the credit. It doesn't necessarily mean that you're selling a municipal bond. It could be a bank loan. So that terminology is a little confusing sometimes. But the point is, unless you're selling a security into the public markets, truly a security like you buy from your broker dealer, you do not need a credit rating. And so you all have not done that. You all have been very successful with bank loans over the years and hasn't needed a rating. Banks are going to do their own credit analysis. We talk to them every day, and whenever they get an opportunity, they look at your underlying credit to come up with an internal credit score or internal credit spread, and that factors into your rate with the bank. So it's very similar to the public markets, and in talking with these bankers and their credit teams over the years, kind of learned what they're looking at, and it's very similar to what the national rating agencies are doing. So we use these national rating agencies as a proxy. Even though you don't have a credit rating, you know, Pinnacle Bank, when they did your refinancing back in 21, they came up with a credit score for you before they lent you the money. So it's a good proxy. You all, I think, right now rated in that AA category. If we were to get a rating, probably mid to upper range of that AA category. County is rated AAA for perspective. Okay, any questions on that? Other than what goes into a credit rating, because I'm going to tell you that next. Okay, so what are these folks evaluating, right, when they establish your rating? And I think this is important, plays into what Scott was talking about, and it's going to play into some of the items that we're going to cover in this presentation. Focus on Moody's here. They honestly have the least number of factors, so they're the easiest to talk about. S&P is going to look at much of the same items. They break it out a little bit differently, but it's the same categories. Economy is 30% of the overall rating, right? And that's things like your resident income is kind of like per capita income, median household income, your tax base, your assessed value per capita. It's underlying population growth. It's GDP growth, right? You know, what is the overall economy doing in the region? That is roughly a third of the rating process that you all, as a board, do not have direct control over. There's nothing that you could have adopted as part of this year's budget to immediately change your economy. You know, there's things you can put in place, zoning policies, economic development policies to encourage the types of development you want to see, the types of growth you want to see, but you can't adopt something in the budget and make that happen, right? I'm going to jump down, skip one on you. Institutional framework, 10%. You're a city organized under the state laws and state statutes in North Carolina. Moody's has determined that is, they're going to determine that is the score that you get, and as a city in North Carolina, you get the best score. Can't control that. Counties get the second best score because they got to do schools and courthouses and jails, but you all as a city, town, get the best score. That adds another 10%. that you don't have control over. That one works out in your favor, but you do not have control over it, right? So that leaves another 60% that you do have more direct control over. The first piece is financial performance. This is fund balance. What levels of fund balance do you have as a percentage of your budget? Are you adding to, or are you pulling down from fund balance, right? That in and of itself is 20%. Another 10% is liquidity. Different than fund balance, your cash position, right? It's a different metric. Fund balance is an accounting position. It looks at your revenues throughout the year that you've earned, but you may not have collected all that, right, at any point in time in the year. So it looks at both your fund balance position and your cash position. And then the last piece, the other 30%, is your debt. They call it leverage, fancy way of saying your debt and debt obligations outstanding. They're looking at your debt, truly your outstanding debt that you have to repay to lenders, and they're looking at your outstanding liabilities, longer term liabilities, pension liabilities, post-employment benefit liabilities. Those are two buzzwords in the municipal world right now, for the last 10 years really, that are looking at, hey, you've offered pensions, and North Carolina has a very well-funded pension system in the grand scheme of things. Other states, not so much. You've probably read about things in Michigan and California where that's what's really driving the inclusion of this, is they got big payments coming due that are to employees who no longer work for them. It's not on their books. It's not a debt piece on their books, but they got to pay. So that gets rolled in with your debt. But for you all, your debt obligations is the big piece of it that you all are looking at and you have control over, and we're going to say you're in very good shape in that regard. Okay? Again, tell me to fast forward and go more quickly if you want me to.
That's good, thank you.
So this is gonna set us up. We're gonna dig into the financial piece. You know, how do we look in there? I was getting there. All right, page 11 is just a look back 5 years at your general fund financial performance. And I think it's important to note we're showing fiscal years 21 through 25 because this is the audited data that's available. This is the way the credit markets are going to look at you. They may ask you a question about, hey, do you have year-to-date 26 or 26 estimates? They'll look at your 27 budget. But what they have audited actual financial results to look at right now is 21 through 25. So that's what we're focusing on. Top half is general fund revenues versus expenditures. And this is really getting to a term that Scott alluded to earlier, a structural balance, right? Are you in a structural balance historically? So the dark green bars are your expenditures, excluding debt service and capital. Those are kind of getting more towards your operating expenditures, your ongoing operating expenditures. The blue piece in there is your debt service payments. And then on top of that, the green is the transfers out in your capital outlay. So the capital that you're spending, the dollars that you're setting aside in reserve funds for future capital spending, right? The gold line layered on that is your revenues and your transfers in from those set-asides in the past. And that's really what we want to see, is that gold line is above the dark green and the blue bars, right? That indicates structural balance. Your annual dollars coming in, the gold line, are covering your annual dollars going out, the dark green and the blue. The light green, some years pops up above that gold line. That's where you're spending, investing fund balance into capital projects. So big picture, right, from credit markets perspective, we're taking a step back, we would say that big picture, you're in a structural balance over the last 5 historical audited years. Your revenues, ongoing revenues, have covered your ongoing expenses. Some years you've chosen to invest some fund balance into capital or set it aside for future capital. So that's a great position to be in from the capital markets perspective. We would look at this and say that's a positive. You all have done a nice job over the last 5 audited years. And then down below that kind of shows how your fund balance in terms of dollars of general fund balance has evolved. And the trend kind of makes sense, right? You were growing through 23, and then 24, you invested some of that money. A lot of it was restricted that you invested in 24. But that's where that light green bar was above that gold line, right? So that makes sense that the fund balance was spent down and then held that pretty steady in 25. We're in a good shape here in terms of fund balance, and you see that a little better on page 12, where here's where we're going to convert it to a percentage of your budget, getting towards that policy, right? And you know, working with staff, understand that target, right? You know, you want to get to got to be at 30%, targeting 40% from a management perspective. And you've been, if you look at the graph in the middle there, this is your unassigned general fund balance. So your bottom bucket, your rainy day funds, your free cash flow, free fund balance as a percentage of expenses. And you all have been above those targeted levels, right? Nicely above. Ended 25 at just over 100% of expenditures, right? So you could, of your operating expenditures, you could pay for a year of expenses from fund balance and take it down to 0, but you could cover a year of operations if you needed to, is what this is telling us from a big picture perspective. I keep saying big picture, right? Audit, because Scott's diving in to the nuanced details of, well, what bank account is that in? That impacts things, but the credit markets don't have visibility into that. They're just looking at this from a big picture perspective. So you're in very good shape here, starting from a position of strength as you're looking to the future from this perspective. And you can see that when you look at the chart on the right. Glasses are smart for these charts,
Yeah.
sorry.
No, that's okay.
This is the first of those peer comparatives that I mentioned earlier. So I'm going to take a moment to set it up for you. You all, 2025 audited results are the gold bar on the top. The middle light green bars are the national medians, highest to lowest, AAA, AA, single A, right? And remember, there's like 1,500 or so cities that are rated. We're not putting every one of them on it. We're taking the median, right? Just the midpoint of that data. And then the dark green bars are the North Carolina rated medians, AAA, AA, single A. And to that, we've layered in on top of that the light blue bar. So that's giving you the range, right? So in the AAA category, somebody's hovering around 10%, somebody's up close to 75%, but the median there is in that 35 to 40% range, right? Yeah. So you all are at 100%, stack up very nicely. The other consideration though here is, right, we always look at this as a percentage of budget to get things on an apples to apples basis. But once you do that and understand you're in a really good position, you also then, as a board, need to say, okay, well, what is our budget versus, say, the AAAs, Charlottes, Raleighs, Winstons, Greensboros, right? Our budget is a lot smaller. Helene comes through, $5 million of damage to Charlotte is $5 million of damage in Waxhaw, but it's a much bigger impact on your budget than it is on Charlotte's budget, right? So finding the balance of having a good percentage and stacking up nicely from a percentage basis is important, but understanding there's a certain amount of dollars you probably want to be comfortable having as well. And I would say that you're in good shape from both perspectives there. Okay? All right, transition to debt here. You all currently have about $19.5 million of debt outstanding. The bulk of that is in this facility, right? Little bit, 3 or 4 years remaining, 3 years remaining on the police facility. And then there was a property purchase that's going to be rolling off in the next 2 years. But overall, $19.5 million. It's all going to be paid off by 2043. And if you, I'm a graphics person. If you look at that graph on the left, I think what's very beneficial to you all is you can see you have this declining structure, right? Your debt service payments are going down every year in the future, right? That's going to be very important for you all as you think about funding capital or operational needs into the future, right? Your debt service is currently stepping down, and we'll get into that in a little more detail. I'm going to introduce, I think it's easier to speak off of this page. One of the key ratios that we look at in the credit markets is the 10-year payout ratio. That's that far right column on page 14. What that's telling you is the percentage of principal amount, par amount or principal amount of your debt are you repaying over the first 10 years, right? So in this case, 27 to 36, fiscal year 27 to 36, you're paying off over 62% of the $19.5 million outstanding. At the end of 10 years, if you do nothing else, you will have 40% of your debt left outstanding. And that's important because you're paying back your debt responsibly. You're not issuing debt and pushing all your payments out to deal with in the future. You're addressing it, you're paying it back responsibly, and that's part of what's creating this declining profile that's going to give you opportunities for the future. And there's a little more on that ratio on page 15 and a couple others. The 10-year payout ratio that I just talked about, a little more detail on the left, you all have a policy, a minimum of 50%. That's a good policy. That's the most common policy we see. And it aligns with the typical debt funding strategy in North Carolina. So that's in really good shape there. Stack up nicely. Middle of the page, debt to assessed value. So you're $19.5 million as a percentage of your tax base, your assessed value, your tax base. And really, this is giving us a measure of your debt load, right? Your tax base is where you generate the majority of your revenue from. And so it's a measure of your ability to repay that amount of debt outstanding. You all, as of fiscal 27, we're projecting right around 0.4%. 0.37 is really exact, call it 0.4% debt to assessed value. Have a policy not to exceed 2.5%, right? So payout was you want to be at least 50%. This is you're not going to go above 2.5%. And that's a good policy level. That's, again, probably one of the most common policy levels we see. And where you stack up on that, down below those peer comps, you're below all the medians, right? You're in a good position there. Last one, debt service to expenditures. This is your debt service payment as a percentage of your overall budget, right? So as opposed to being the debt burden measured against your tax base, this is your debt burden managed against your annual budget, right? How much of that budget are you committed to making a debt payment? It's also not just a measure of debt burden, it's also a measure of flexibility, right? Because a debt service payment is a fixed payment. LGC, state, is going to make you pay that debt payment. And it's a fixed amount. You can't furlough a debt payment, turn the lights off early on a debt payment. It is what it is. You got to pay it. You got to come up with it. And so that's an element of your budget that's not as flexible, right? That you have as much control over. So as of fiscal 27, you were sitting at about 11.8% debt service to expenditures. Policy not to exceed 20%. Typical policies range from that 15 to 20% mark. You all are on the higher end of that policy, right? Mm-hmm. That was on purpose because of the nature of the town you're in a growth mode. You've been in a growth mode. Yes, growth is slowed, but you look back over 25 years, right? You've been in a significant growth mode. That comes with infrastructure investment, which you've been doing, and it comes with a budget that's going to continuously grow into your size. We talked about the commercial development, right? I mean, we see it all over the state, right? In areas outside of urban centers, residential comes first, then commercial comes, and that's when you start to see the budget increase significantly. So you're in kind of a catch-up mode on this of investing in infrastructure while the budget continues to catch up. And so when the policy was set, it was set to give a little bit of room, give a little bit of flexibility, and you stack up nicely against that policy. If you look down at that peer chart, right, you're a little bit on the higher end of that debt service to expenditures, right? Above the medians. You're certainly not in a bad position at all, but of these ratios, this is the one where you are a little bit higher than the median. That's not a function of the amount of debt you have. That's a function of your current budget level, right? And how quickly you've chosen to amortize debt service to expenditures. And in your current policy, the way it's written, the 10-year payout ratio and the debt service to expenditures are kind of written together in the policy because, it's kind of like squeezing a balloon, right? Okay, our debt service to expenditures is getting high. We need to address that. Let's extend the amortization. Let's pay off our debt more slowly. Well, then that's going to hit the payout ratio. So it kind of tries to keep it in a little bit of a balance there. Overall, you're in compliance with your policies. You're not an outlier compared to the peers. Look good against most of these ratios. We would say you have debt capacity, right? You have capacity to issue additional debt if you want to. You have capacity to use debt as a tool if you choose to do that. The related conversation is affordability, right? So go back to my original metaphor. I went to the bank, I got pre-qualified, they pulled my credit score, I got pre-qualified for a $300,000 mortgage. Great. But then I started thinking about it and I was like, well, gosh, I got to buy all new appliances. Parents are getting older. I've got to help with them. I may have kids someday. And all of a sudden, like, my monthly payments are saying I can't afford that $300,000 payment, right? So just because you have capacity doesn't necessarily mean it makes sense. And that's what we're going to look at on the next page. Spoiler alert, you're going to have affordability if you want it too. But this is the last numbers thing I've got for you, I promise. Left to right here, though, I think it's helpful to understand this. So it's all set up by fiscal year, starting in fiscal 27. And all we're doing right now is simply looking at your existing debt service budget in column B. We've got placeholders if we want to layer in proposed debt or cash funded capital. But column B is simply looking at that existing debt service. And you see there's some really nice declines over the first 4 years of that debt, right? From 27, it's going from 2.6 million down to 1.5 million in 2030. That's great. And so you would look at that and say, gosh, we're going to pick up over $1 million in our budget over the next 4 years, a couple pennies worth plus. But it's important to understand where those dollars coming from as well, which is what we do in columns F, G, and H. Right? And some of that debt in column B was for the athletic barn, where you all have collected revenue for that already, set it aside, and are spending that over the next 2 years. So those dollars are not built into your budget currently, your operating budget currently, right? They're coming out of dollars you previously set aside. So when that debt pays off, it's not going to free up a bunch of money within your operating budget. Right? So we got to pull that out separately. And what that leaves us with is about $2.17 million that's in your current operating budget. And for perspective, what we've said is it's in your budget from recurring resources. You could choose to lock that amount in and say, you know what, we're going to lock it in and we're going to leave that set aside for debt service. If we don't spend it 1 year, we'll set it aside for future debt service or capital, but we're gonna lock that in as a funding source. We're not gonna take it for operations. That's what we're showing here. And if you do that, column I is showing you the annual cash flows, right? So this is your future annual affordability, right? Where, you don't really pick up a lot of step down until fiscal 29, because those first couple of years is where that athletic barn is paying. But after that, you get into 300, 600, ultimately getting out to over 700,000, 800,000 a year of freed up affordability just within your existing budget, not growing that, just the same amount that you have in there. And so I think as Scott was setting up the conversation earlier and talking about some of the decisions y'all have to make, well, I think this is a real consideration for you, right? Do you want to keep these dollars that you've already got in your budget, currently dedicated debt service and capital? Do we want to lock those in, or depending upon how things evolve in that low growth scenario, low growth, continued inflationary operating expenses, where if you don't do anything, you got a big number at the end? Well, this can also be a tool to address some of that, right? So you could choose to say, you know what, in 29, I need to use that 300,000 to help with the operating budget. That's absolutely an option for you. Mm-hmm. But you also have to weigh the other side of that. Well, what does that mean for my next 5 years of CIP, right? So I think it's fair to say, and I don't, if I say this wrong or if I'm speaking out of turn, tell me, but from what I see in the audit and the budget and the steps you all have taken setting aside some restricted dollars, and based upon your existing fund balance, you have roughly $14 million, give or take, CIP. With the dollars you set aside, your fund balance, you could fund all of that in cash and still be in compliance with your policy if you don't, if you don't have this scenario where your operating expenses grow like this and your revenue is still growing like this, right? That's the big question out there. You evaluate that regularly, but you could fund everything with cash and be okay if you can manage that growth both on the expense side and the revenue side without issuing any additional debt. The question, though, is in that next 5 years, where does that leave you, right? So if you were to go, say, yes, I use my fingers, 31. You go out past 31, right? You look into 32. After that 5-year mark, you got 730,000 of annual cash flow without any growth in your current dedicated budget, without having to come up with new revenues. That would support about $7.5 million of a debt payment, right? So you could do a $7.5 million project without any new revenue 5 years from now. But if you need to use those dollars for operations, then you don't have that capacity, right? And so the question is, and this is why you guys get paid the big bucks, is what is the best use of that? I think that's going to be the
Wait,
question.
that's news to me.
That's going to be the question for you all, right?
You missed that one? Just a minute at that meeting?
So anyway, so that's going to be the question for you all, right, as you go forward, is what's the best use of these dollars within our current budget? And you will have some affordability if you choose to set it aside. If you pull it into operations, you'll have to find new revenues to continue funding the capital program if you want to do that, beyond just the annual capital funding that you have in your budget. And I think that's an important note, right, to say, and I know y'all know this, but I feel like I got to say it out loud, right? Pulling dollars in to the operating budget is not a one-time thing, right? It's not like a one-time fix, right? If you pull that 336,000 out to help plug the gap on the operating side, that's gone, right? Operating is a recurring expense. You use recurring revenue to fund it 1 year, you got to leave it there. If you take it away, then you just got to keep plugging the gap, right? So what we've seen over the years is if you take money out of this to go towards operations, it's not coming back, right? And so that's why it's an important decision. It's not just a one-year decision, it's kind of a ongoing decision when you make that. And I'm not saying that's a bad decision, right? That's just, you got to balance and understand what happens if you use it either way. Okay? Told you I get excited about this stuff, so.
You were very excited.
Is that, you good there?
Paints a good picture.
Okay, keep rolling here. As we talk about that, you've got debt capacity, you got debt affordability. If you want to use some of that now or in the future, I think a few education pieces, right, on borrowing money in North Carolina. I know y'all are doing the police station right now, but it's been 4 years, 5 years since the town's borrowed money. Any financing in North Carolina, other than a vehicle financing or a really small, short financing, has to get approved by the local government commission, right? And the local government commission is formed by state statute, and they have to make certain findings statutorily to be able to approve your debt. Even if they want to approve it, if they can't make these findings, they can't do it. And there's a couple of key ones that I think are important for folks to understand. And probably, I would say the most important is the amount proposed is adequate but not excessive for the purpose of the bond issue. What that means is, are you borrowing enough to fund the project, right? They don't want to approve a piece of debt and you get steel coming out of the ground and you're done. You don't have anything else to finish the building, right? Likewise, they don't want you to borrow double what you need for the project and then have this extra money floating around. Well, what are we gonna do with it, right? They want to know that you've got enough, but you're not going to be left with a huge chunk of borrowed money that you're paying interest on that the project's done. So in order to do that, I'm building up to a point, I promise. In order to do that, what the local government commission staff wants to see is that you have bids and permits in hand. And this is kind of bringing full circle back to the cash flow conversation. Because even if you're going to borrow for a project, when we borrowed for this project, the town had to cash flow the design and chose to cash flow some of the site acquisition and site prep work until you can get to a firm cost for the building, right? Bids in hand or a guaranteed maximum price in hand for the facility, right? So, smaller little one-off type things, a roof replacement, maybe that's not that much, but a facility like this, you're talking millions of dollars for the architectural and soft costs and preliminary work that you have to be in a position to cash flow. So I think that plays back into the conversation of what is the proper cash position. Well, part of that is understanding what are your capital goals in the long term, and having a cash position, fund balance position that provides you flexibility to get started on those projects, get to design, such that you can choose to debt finance them. And you can reimburse yourself from the debt financing for those costs and rebuild that fund balance, but you gotta have it for some period of time to cover those preliminary costs. Okay?
Okay.
And to show the local government commission that you're at that point.
So that, and that's the other piece. Debt management procedures, policies are good. Reasonable assurance to be given to the debt in strict compliance with law. Increase in taxes, if necessary, to service the proposed debt will not be excessive. All of that's getting to, do you have the financial wherewithal to repay the debt? If you've got a really small cash position, if you don't have free cash flow to pay the debt, they might not be able to make that finding. And we've seen them in the past say, we're absolutely happy to take this before the commission for approval. We would love a resolution from the board that says they're willing to raise taxes, blank pennies, whatever the amount needed to support the debt is, so that we can make this finding. So they are looking absolutely at the financial piece of it as well.
using the taxpayers as collateral, basically.
It's a willing, I think they view it as if the board is willing to adopt not your board, a board is willing to adopt a resolution saying they will raise taxes by this amount, they're going to take the heat for it anyway, so they might as well put it in place. I think that's the theory behind it, at least. But they just want it on record that a board has acknowledged that tax rate is necessary if this debt is issued, and that gives them the comfort that they have the willingness to do that if it's necessary. So that's just a little bit of background. Oh, go ahead, Scott.
No, I was going to
Agree with that, number one. And number two, so as he's talking just on the page back, just so I've been in front of the LGC, gosh knows how many times in my life. They're serious about it. They're serious about this. The state has a AAA bond rating for a reason. It's because of the LGC, and because the LGC then manages you folks. You know, this is a Dillon rule state. You don't have any authority unless they give it to you. And this is one of those reasons we're able to have that kind of a bond rate in the state, is because there is a centralized control system through the statutes on borrowing. And you know, really the guardrails that they put in here keep you from going past the guardrails, which is why banks like to lend here, why the market likes North Carolina, is because you have to live within those guardrails. Now, that doesn't say that the politics are always there, but the guardrails by North Carolina general statute are very, very serious about this, and it's why it's a good market to borrow in and to build in from a public market perspective. I just wanted to reiterate.
Yeah, absolutely. That's why we talked about earlier, right? That North Carolina stacks up very nicely on the rating scale. This is part of that reason. The other thing I will mention about the Local Government Commission, I'm not going to walk through it, but they do have a fairly detailed process and procedure for getting approval, which is kind of in that bottom left chart. It's not the type of thing where you say, oh gosh, our cash position is low, let's go borrow for one of these projects and replace our cash position, you know, in 3 weeks or a month. Like, it's a process to get there, and you got to hit the timing right to get to their meeting. They meet once per month, and you got to have the application a month before and a couple things 45 to 60 days before their approval. So it's a process that you've got to go through. So I just think that's important to understand. All right, last piece for me. And I don't want to repeat things that Scott has covered, but big picture, right? Capital funding options in North Carolina. Scott talked about the grants. Always great. Don't have to repay it, whether you don't have to pay interest on it, and you don't have to pay cash out of pocket for it, right? It's free, quote unquote, free money. Issue is a lot of times it can come with strings, right? And it oftentimes doesn't fund the entire project. It's often a piece of the puzzle, part of the capital stack, but it doesn't fund the whole thing, which is where you come into these next ones, you know, pay go cash, right? Great. If you can pay cash for it, avoid interest, and you still have a very solid fund balance, that's a great position to be in. That's option number one. But also have to understand a couple of things. It takes a long time to build up your cash balance. It's very easy to spend it, right? And then once you spend it, it's hard to build it. It takes time to build it back up. Like, I think that's part of what Scott was demonstrating with that other graph that scared everybody. So that, but I think that's kind of the point, right? Pay-go cash is an important tool. Oftentimes we have CIP policies that include a minimum amount of pay-go cash, but if you're going to fund a facility like this, a large road project, large police station, fire station, that can take a significant impact or hit on cash, and so maybe some combination of grant, cash, and debt is a good strategy. When we look at the rest of these options, these are the debt funding options, right? So if you go through, we didn't get enough grants, don't want to spend all our money on cash, we do want to look at debt. These are our options. And one last thing on PAYGO, because I know y'all hear about this as a public official, but I think it's important to say. The other consideration is you've collected that cash over the years and you pay it out for a single project. Well, prior people have paid for that project. They may not be in town anymore, right? So a lot of people look at debt as kind of a tool to supplement cash to help pay for it from prior years, and people who are using it in the future help pay for it as well. So that's one of the other considerations with debt versus cash. But your options, Scott said, you don't have a water and sewer enterprise fund, right? So we kind of, or electric fund or any enterprise fund. So you kind of cross off the revenue bond option. That's not really an option for you all right now. Special obligation bonds are an option for towns and cities, particularly because it is a pledge of non-quote tax revenue, a pledge of a revenue stream that you do not levy. And what that means for you as a city or a town, generally, in North Carolina, is you can pledge your sales tax. And that is the most common thing that we see used. However, the use is pretty limited, right? It's restricted for certain types of projects in certain types of areas. Unless it's a very specific project that fits within the statutes, it has to be within a municipal service district, which is a process to go through. So that is going to be a tool for you for very select and projects that fit, but it's not going to fit everything, and it's not going to fit the projects on your CIP right now, most likely. So that leaves you with the general obligation bonds or installment finances, right? General obligation bonds, I'm going to repeat here for a little bit, a pledge of the full faith and credit and taxing power of the town. We have a tax cap in North Carolina. It's a high tax cap, but it is a tax cap. It does not apply for general obligation bond debt service. So voters approve it, has to go to referendum, voters approve it, you have to pay it back. Regardless of what the tax rate has to be, you're not restricted by the tax cap. It is a full faith credit taxing power pledge of the town of Waxhaw and the voters who approved it. That is why it is the best credit. There's no, default and come take my building. There's no like, oh, I gotta, give up on this. Like, the lender's gonna get paid. It may take them time, but they are owed that money by any and all means that you can collect revenue. Lowest cost of funds. It does take time, right? It's about, so for a November referendum, the latest that you can get started on taking your actions is June. Maybe July, but June. And that's your formal actions, right? But there's a series of steps that you've got to go through to get there, even to the point where you're ready to say, all right, this is the amount, this is all the details that go with it that you have to do. Most people get started with formal actions April, May timeframe, and planning months.
For now.
Formal actions April, May, but planning, the fall prior, leading up to it. And if I'm telling you things you already know, tell me to stop and move on. There was a change to general statutes in North Carolina a couple years ago that amended what is required to be put on the ballot. 2 years before that, statutes amended some of the actions that you all as a town and board had to take leading up to a referendum. So go back to that first change. You have to publish on your website what's called a statement of disclosures that says, this is what we're issuing, this is what we're proposing to issue with the referendum, this is what we estimate the interest costs over the life of the bonds will be, and this is what we estimate the tax rate impact of the bonds is going to be. And you publish that on your website, and it's available for the public to review before they vote. But at that point in time, the question was, do you want to approve X million dollars for streets and sidewalks general obligation bonds to be issued by the town of Waxhaw, right? Yes or no, right? That's where we were. Now the new legislation, it's been in effect for like 3 referendum voting cycles at this point. Now that ballot looks like about that long. And it also includes, shall the town of Waxhaw issue X million dollars for streets and sidewalk, general obligation bonds, understanding that the total estimated interest cost over the life of the bonds is X, and the property tax liability per $100,000 of property value is Y. And you all, as a board, establish those amounts, but the LGC doesn't approve the referendum, doesn't approve the GO bonds until after the referendum. It used to approve it before. Now they approve it after. And they've got a series of safe harbor interest rates that you use for those calculations, and they have to find that your calculation and disclosure of the tax rate is reasonable, right? And if you go out and say, we're gonna, shall the town of Waxhaw issue 500 million of bonds to, do all this really cool stuff that we don't need, and it's not gonna cost us anything on the tax rate, and everybody's like, heck yeah, let's do it, and then the LGC is like, no, that's not reasonable. We can't find that that's reasonable. Then you've gone through this whole process, and the bonds don't get authorized, or you don't get approved to issue the bonds by the LGC. So, gotta be very careful and following the guidelines, and we work closely with LGC staff and share the assumptions and make sure staff is comfortable and doesn't see any red flags when doing that. I say all that to say that's a process to go through the general obligation bonds. And it takes time, and it is not necessarily a slam dunk, right? It could not be approved.
Oh, we've seen that.
I know you have. And so that's a consideration when using general obligation bonds. The most common things we see general obligation bonds for: streets and sidewalks, parks and rec, and county side schools, right? Because those tend to be popular projects, right? A lot of public support for those type of projects. And on, particularly for you all, streets and sidewalks, parks and rec, those aren't great collateral, which is our next option, right? Installment financing. Pledge of an asset, right? You may hear it called 16820 financing. That is the general statute that authorizes it. Can be a pledge of vehicles, right? And you will secure those vehicles with the UCC.
Yeah, that's right.
But it's a pledge of an asset, right? This building has a mortgage on it, right? It has a pledge, it is pledged to the financing. It was an installment financing. You may hear them in the public markets. Now sometimes with the banks, we'll call them limited obligation bonds. Same thing, installment financing, 16820, limited obligation bond. And you are putting a mortgage on a building, a lien on police cars, whatever. It's a pledge of an asset. Used to be no problems doing these. This guy remembers the old BB&T, love to lend. But prior to 2008, and then after 2008, there's sort of different credit standards. We used to do installment financings for streets regularly. We used to, do installment financings for raw land for future development and all that, no problem. Now banks are starting to really focus on essential collateral, essential governmental collateral in your case. And so that is, town hall is perfect. A park, marginal. A piece of raw land for speculative future shell building development, a lot harder, right? So a street, really hard, particularly if you don't own it. But, you know, we used to get around it like, hey, we're pledging the asphalt that we're buying and spreading, right? That was the pledge on some of these loans. Because statutorily, we had to pledge something. Can't really do that anymore. Still some people who will lend against streets, but like, I've seen it go out like 7 years. Like, you're not gonna borrow 20 years with a street as collateral with a bank, most likely. So that's where you kind of look at these things in tandem and say streets and sidewalks tend to be public support, not really great collateral. I've either got to be in a position where I can pair that street project with another project that gives me good collateral to be able to issue debt to fund that, or I might need to be looking at the general obligation fund. Well, how much does that cost me, right? How much does installment financing cost me versus GO? I would say a LOB versus a GO bond is in that same, 5 to 25 basis points. GO is better, and you're gonna get a better rate, and you're gonna have easier access to the markets. It's less to explain, and it's gonna be a highest credit rate. It's gonna give you your town's credit rating is gonna be your GO credit rating. A LOB is gonna be a notch off, because the other important thing, it's subject to appropriation. Scott will pledge to include that payment in his budget to the bank, but you all have to adopt the budget. You all have to appropriate it. You could choose, you could say, Scott, we're not adopting that. Take it out and bring it back to us and we'll adopt it without it. And then, LGC is going to be knocking on your door, and as will the bank, and saying, hey, how are you going to pay me? But you do have that option. So it's rated a step below your GO. I could talk all night, I'm sorry.
Okay.
This definitely, I think, paints a much, much clearer picture of some of the things that we've been discussing over the last couple of months, so thank you.
Yes, sir. Hopefully I did.
I have
That
to
was good.
personally digest it all.
Yeah, I got to think about it, but I understood everything as you're saying it, but it has to marinate for a little while.
Absolutely, and I mean, I think as you're considering these things, right, you're considering big picture items, longer term planning. Decisions you make today can influence what you can do 8 years from now, but you also don't know what that picture looks like 8 years from now, right? So I think it's finding the balance of committing to do, planning to do certain things in the future, but having the flexibility to adjust depending on how things evolve.
And I do think the changes in the explanation of the GO bond is an improvement, because no matter how many times you tell people
Everybody knows.
that, it's a tax increase, then when the tax bill comes, they're like, why did my taxes go up? Well, because you said yes to the school. So, I mean, I know that's what the county battles all the time.
Hopefully you didn't think I was being negative about
No,
that. That
no,
was
that's
totally
just-
informational, right? And I think it's
that's reality.
But it's a consideration, right? I mean, before it was like, well, everybody's going to vote for it because they want to vote for schools. But now, maybe it's not a home run because
makes
there's
it
more
clearer.
information on the ballot, right?
Yeah.
No, it makes it far more transparent, much clearer to the voter than I've seen in other states, so it's a good thing.
I would also,
Hello? I would also add, there's a couple of things that we have been debating back and forth simply because I'm doing more scenario planning against what I think the operations are. If I have 2 low growth years in a row, that concerns me because a $3 million drawdown that you weren't ready for has a much stronger impact against cash. It's always this tension between your cash balance, the interest that you earn. So both of us agree that nominal interest rates are, you don't want to borrow in an atmosphere of 5, 6, 7, 8. You would not want to do that, but you also don't want to lose the ability to earn in that period of time too. So you're balancing the arbitrage between what you're paying out in interest and what you're earning in interest. So that's a consideration. And if your growth is lower, now again, things could change tomorrow. That's why predicting past 2, let alone 5 right now, is getting harder right now for us to do. However, the capacity argument is a very solid argument, because in some of the analysis that I did is I took that capacity and locked it to say what happens after year 5. So the mayor and I had some conversations about, well, what happens after 5? What about the next 5 to 10? There's 2 things that are true. You're always going to have something that comes up you have to pay for. You're always going to have rising costs. It's going to cost more 5 years from now than it does now. It just does that. Those 2 things holding and being true, though, if you contain and cap capacity and then set aside, then what you're saying to yourself is within the current atmosphere and against the future, you have capacity in there to then treat the next 5. Because if you borrow, you got to pay. So now it's converting over to debt service again. So that's kind of what that step down does, is it creates this capacity, but you have to lock it. You have to not let operations rob it, or the rise in inflation, or the increase in the cost of something. That any one of those things can be true right now. You know, we could wake up tomorrow and aluminum's more expensive. Matter of fact, I know aluminum's going to be more expensive in the current tariff war. I mean, because the majority of that aluminum comes up north. So, and that was an agreement we had for 50, 60, 70 years. But regardless of that, but you don't know that when you're planning it out, and that's that sudden rise. If it's a sudden rise within 1 standard or 2 standard deviations, it's one thing. If it goes to 3, now your costs are spiraling all up and your revenue is going in weird ways. So scenario planning is very difficult. I'm more panicky about scenario planning simply because I don't know what operation comes tomorrow. Now, just wanted to kind of guide that. So in the material that you're getting from me when you see those tax rates, I'm going worst case scenarios, because I don't know how to go in a moderated sense right now, because we're not in our last 5 years. We're in a very different growth pattern right now, so it's altered it. Secondly, in this current fiscal year, you're already out $3 million by December out of your capacity, out of your cash on hand. You'll be out another 3.5 if everything went. Now, what we've asked staff to do, and we've looked at, is we've said, okay, some of these are planning dollars or those pre-dollars before construction. So we think we may actually have more play between now and, let's say, next June than we previously thought. I mean, how long have you all been dealing with Helms Road?
Oh,
Okay, a long time, right? Well, I mean, you budgeted in the year before I got here one number, and it stayed the same. We budgeted again, and it stayed the same. We're spending on it now. Now, one of those years we moved it over, last year we moved it over into savings. The year before that we did not. So guess what it did? It evaporated. Right. So this budget idea, or that capacity idea, went away because your operating costs were rising. And in the last 5 to 6 years, you've had an extremely elevated level of operating cost increases. People cost more, health insurance costs more, materials cost more, supplies cost more, gas costs more, all those things. On a set, Mitch and I have been around for long enough to know that 2% was normal and was actually probably deflationary when it came to CPI, quite frankly, especially against the arbitrage in between what you're paying out in debt structure and what you were earning.
I mean, you just have to look back at your current interest rates. I mean, your 2021 installment, that was a refinancing. I think we did it for 1.38%.
right.
Yeah.
So you've got a positive arbitrage there, but what we didn't do is we didn't capture the capacity created by the arbitrage. We ate it up. We ate it up in cost. And so now I think the discipline's there, but it's still, you can only control so much in your cost structure. So,
So the bulk of what we have in terms of debt right now is bank debt. And that's a decreasing payment,
Yes.
which is nice.
yes.
would GOs work in a similar fashion with a decreasing payment?
Yeah, so.
And then what's the term then? Is that a 20-year usually note or a 30-year note?
Yeah,
Or
so
do you get to decide that?
Yeah, so you go back to that LGC, right? Debt management procedures are
Yeah.
good. LGC staff, historically, for a governmental project, doesn't want to see it go longer than 20-year term,
Okay,
and they're going to want to see a level principal amortization, right? Which creates that declining debt structure, right? So
gotcha. So the principal's fixed, but it's your
Yeah.
interest that's falling.
simple numbers, $20 million
yeah.
financing over 20 years.
Gotcha.
You're paying $1 million of principal back every year. First year's interest is the highest because it's on the full 20. The next year it's only on 19. Next year it's on 18. It's
So it starts to almost make sense at a recurring level or at a recurring basis, because that's what I'm thinking. I don't want people to be cursing my name 20 years from now. So it starts to make sense when you look at the fact that you get a 20-year note, and then in 5 years, you could afford another 20-year note. It'll all be kind of balanced out. That decrease in that today's 20-year note is going to be a decrease. Okay, that's fixed. And then you can take that fixed amount, you can put it towards another 20-year note, and so on and so forth. And that then becomes the train of debt that the town is then living on. The fear is creating a culture of subsequent boards that just say, yeah, we're just going to get another GO. We'll just get another GO. And people will be super excited about the new roads, the new park, the new fields, the new lights, the new amphitheater, the new swimming pool, the new everything. And they'll just start approving it all because the GO bonds, though, that's great. I can do it all without having to raise my taxes. And that's kind of the cycle that worries me that people might get into, is they get drunk on the easy money, basically. But if we look at it as a 5-year cycle, it starts to make sense. And I think one of the things, again, we're still talking about whether or not we want to do it, but one of the things I want to know, and my question here was, we need to see some kind of analysis on rising costs and falling debt responsibilities. Because if the costs just to keep the lights on are going up more than that decrease in debt obligations, then what I just said about a chain of debt is moot. It's all useless. It's a train wreck waiting to happen. So I think
that's the easy thing to grab, right? It's like, well,
Yeah.
we got, we're short a penny this year, but debt's down 300,000. So let's just grab it and
Yeah.
and we'll plug that gap this year. But really, when you grab it, that's plug the gap every year.
Right.
And so that strategy of decline and taking advantage of that in the future is gone.
Because it's almost, what I'm getting at is we should almost get used to saying, we have, based on these, it's like a $2.5 million debt is what our budget is used to and has been for the last couple of years. And we know it's going to go down, especially when you hit year 5, it's going to go down appreciably. So if we're used to $2.5 million in debt service, keep that fixed.
Yes.
And then you borrow whatever is needed, not what is needed, that's kind of a wrong way to look at it, but it allows you to then borrow the amount that keeps that fixed. And I think one of the keys to that, what makes it even better and smarter, is especially the first 5 years, and as long as you can, keep the payment fixed. Because one of the other questions I had is there prepay penalties on any of this stuff? So,
Yeah, it's going to vary by bank. And it's
Yeah.
going to, in the public markets, typically you're going to have a 10-year
Window before you do that.
closeout period, right? So
yeah, so you can pay early, but you just can't pay 9 years early or
Yeah.
11
Yeah,
years
you
early.
can, well, you got to wait 10 years for a public sale, and then you can start prepaying.
That's right, yeah.
For a bank loan, it's going to vary by bank.
Yeah, 5 to 7, somewhere in there, depending on the length of the term.
Yeah, some will let you do it immediately. Some
Yeah.
will let you do it immediately with a penalty.
Yeah.
But
Because I'm thinking the only way to stay disciplined with this, the only way to stay disciplined is to assume you have a fixed amount, and I think it needs to be a fixed dollar amount, not a fixed percentage. But if you live on a fixed dollar amount saying, this is how much debt we can afford, and we can afford this in perpetuity. Okay, how do we manage that debt? What bonds do we get that are within that amount. So that when one bond note is going down, okay, you've got room for the next bond note.
Yeah.
And then that'll go down, you've got room for the next, and so on and so forth. Because that's the thing that's been bugging me about this whole thing, is like,
Sure.
how does it work long-term?
Sure. So you can look at that two different ways. In your budget this year, we labeled it as an expense, 250 to capital outlay, 250 grand to capital, to Fund 403. That's 500,000. To me, that, the way I came up with that number is a differential between what our debt payment was and our declining block. So we say it that we're putting it into a reserve position. So you are disciplined in that. The other way you could do it is you could say, okay, go back to what our actual cap would be, which is 2.5. So you're at 0.5 right now. If you said, I could, because I have aggressive growth coming, I'm going to target 2.5%, and that amount is 3.6 million, 3.7 million, and that money always gets paid. It's at the bottom, and then you discipline yourself. You put it into a reserve fund, but the language in the ordinance, now remember, the next council, the next Board of Commissioners, who's elected by the people, can change that. So it gets hard to fix that. The one thing about borrowing with debt against that kind of a discipline is that the GO bond kind of disciplines the next board into reserving that debt amount.
Yeah.
Maybe not with that capacity built into it, but they have to make the payment. Growth hits the floor. They got to figure that out. Growth keeps going up, you're in a good position, right? So that's the elixir, unfortunately, that's what you're concerned about, is that elixir effect of growth. I'm concerned about it too, only because I would rather be disciplined in that capacity, kind of like what and you as a board are doing that right now. You've set aside 500. And then we did 2 management plays. We moved your concentration of outflows over the next 6 months into a position that it wouldn't dip and hurt your cash flow position. And then secondly, you're borrowing on the police cars on a 3-year, very short note below depreciation, because those cars are depreciating at 5, 7, or 8. You're putting it at 3, so you have a higher retain earning at the end of that, so you can flip that number. And now you've brought it down into a $200,000 payment, so you've just built $300,000 of capacity back into your number again, and that's in that million that he and I are going back and forth about. So we know what that first trick is, but you have to say it and you have to be disciplined towards it. Borrowing, in my opinion, disciplines you more. That because I'm concerned about, because we're not so big, we're only 24 million. And I know that sounds like a huge number to the folks who are like, oh my God, I just can't imagine 24 million. I haven't heard millions in years. I hear billions now. I hear trillions now. I hear hundreds of millions. I hear very different kinds of numbers now against millions. Millions reminds me of a couple 100,000. What used to be a couple 100,000 on a borrow now. So I think what I'm trying to say is that, as his example said, 5 million to Charlotte's one thing, 5 million to us is a real kick in the butt if that money goes out. So I agree with you. I think the discipline has to be part of that conversation. Yeah. I don't disagree with that at all. You have kind of the subset to that, using a little bit of a different language, and so I would encourage you to go back into your budget book and see that number and see it for what it is right now, because that can because of our cash position right now at 103% on the unassigned. That cash position right now allows you that capacity and that ability to be disciplined about those things in that million and think about that across time. I think the board's in a good position from a policy perspective to think through that process and then plan the next 5 years after the 5 that we're talking about. And then you plan another 5 past that, and you build a debt structure back into it to see what capacity is really there. And you play that number out on the long run. And to me, again, I'm sorry, but long run anymore is 5. So, but you're building it at 7, you're building it at 10, you're trying to build it at 12 and a half, you're building it at 15 because if you do borrow, it is a 20-year note. If you borrow 10 million and up, you borrow at the terms that make that payment structure work and create the capacity you need for the next borrowing.
Yeah, exactly.
And so that's just the one way I would say that to you as you go through your thinking process on this. Like I said, we're not looking for an answer tonight, but some of the things that we want to understand from you folks is what we're saying making some sense on cash flow as it looks over the next 5 years and 7 years. I'm going to add the 2 years beyond that. It may be time, because we may have time, because we're spending our own dollars, to think about reimbursement resolutions against projects. So to think about, Matt, for a recapture of any funds that you have out that hit the hard number that you can then get reimbursed on, and that's the construction part of it or the building part of it. They don't reimburse you a lot on your planning dollars and your some of those things.
Yeah, and that's really tax rules, right? Right. As a municipality, you can issue tax-exempt bonds, which gives you a lower interest rate than if you were to issue taxable bonds. But there's a lot of IRS regulations. I'm not a bond attorney or an attorney, so I would be very careful. But
play one on TV?
State of Holiday Inn Express. Either way.
Exactly.
The reimbursement resolution, all it does is say, puts a kind of line in the sand for a certain amount of money that you may spend on a project that says we intend to issue or may issue tax-exempt bonds to reimburse ourselves, and it gives you a window to be able to do that. And you never have to do it. You don't ever have to do it, but it keeps your flexibility to do it on a tax-exempt basis, which is the lowest cost of funds.
And then the last piece, you've actually started to have that discussion on, and that is on that that budgetary disciplinary planning process of how to deal with debt capacity, how to deal with cash position over time.
Yeah.
And that's the last part of the kind of direction. I'm glad you brought that up, and I'm glad you put that on the table, because that should be part of your consideration as you move forward. How do we anticipate paying it back 7 years from now, 5 years from now, 2 years from now, 10 years from now? Yeah. And if that kind of thinking is working in there, then your conversation is also about budgetary discipline, which one affects that best to capture. And then there's the political piece, and that is, what do the people want? So, making sure that you're in tune. Well, and I think the legislature, quite frankly, I think North Carolina's always had a very good, its fiscal house in order. The LGC keeps that. As a city manager in my career, I have been scared to death of them over time, because it's guardrails. They're putting you in a box, and they want you in a box. Actually, I like being in it. Because you can't go over certain capacity issues. You know what the rules are. So you play against those rules, and you do against those rules. So I actually kind of like that, to be completely honest with you. But to go back to the initial point, and that is to know from the people, those are investments worthy of my time and I think my kids' time. So thinking about the next generation that comes in and pays for it. Also, the last thing I would say on the politic end is using your savings are the people that lived here before. I think that's a great analogy. Debt is for the future to come. If you think growth is coming in, you're making them pay for some of that or all of that or some portion thereof, and participating in that process.
I think that's an effective way of looking at it too. And I'm also encouraged by, I think you spelled it out quite nicely when you mentioned debt capacity, and how you're setting up a structure that has this built-in capacity that's just down the road. So it's not as if you're burdened by something that's continuous and constant and just going to be a drain. But if it bakes in capacity because of a falling payment, then that just kind of, you get used to one payment. If it stays flat, well, it's not. It's going down. So you have capacity for other stuff. Because I think, again, that's what subsequent boards, they'll have their own list of projects that they want to do. And I know that we've taken our CIP and we chopped it down to 5. And they were all road projects. All we got to do is dust off that list, and there's the next bond 5 years from now. And go further down that list, there's the bond 10 years from now, and things of that nature. So I like the fact that, like you're saying, there's discipline built in, and then there's a structure that builds capacity into it with time. So,
Yeah.
thank you. Great discussion.
you.
Any other comments, questions? I feel like
Yeah,
I'm good.
hit the nail on the head.
thank you.
Exceptional, appreciate this.
Yeah, thank you.
Yes, sir. Thank y'all.
Great talk. And I'll just highlight, just to restate it for the public, you're a fiduciary, you're an advisor. You're not here to sell anything. So I think
Fiduciary means
that's-
you're required by law to be on our side.
Exactly. Exactly. And we appreciate that. And
Yes, sir.
I want to thank Scott for bringing you in and
Yeah.
explaining all of this to us. So that's very helpful. Awesome.
All right.
All righty.
Thank y'all.
Thank you.
Thank
you.
Hey, safe travel.
Yes.
Kevin,
Next up.
Really have much, unless you guys have any questions.
no, come on up.
Yeah, that's kind of the opportunity. So
We were looking forward to something really long.
8:45, right? Yeah, we've got our last bit of
Is it
capacity.
8:45?
so my wife is going to be short.
It's your fault.
We on?
Agenda. Look at the agenda. It's deceptive.
Okay.
Short
No,
dates.
I think we are, in short, I think we're on track with the agreement that we've got with Pulte right now. They have met with PD. They are trying to hammer out the scheduling for the officers there. And then they also have to set up the $2 million bond. They have been in touch with James, and they're getting that established right now. Once they have those two things in place, they should be able to get the 3 COs per month starting in September. And then in December, we will get the signed, but by December, we have to have the signed contracts back from CSX and from DOT, and they should be starting work around then too. I think they're going to be moving pretty quickly though, depending on when they get started with the weather and everything.
It's been encouraging to see that they're moving forward just with the bond, and
Yeah.
they're working with PD. So we're going to get when do we expect to see an officer there then at this point?
That's the question. As soon as
Should
they
be
get,
Monday, right?
yeah, right, yeah. They got to get those two things hammered out. I mean,
Okay.
it's the
Well, it
first
really
is,
shouldn't
was
be.
it Monday, Tuesday, something like that?
Yeah.
So, I mean,
Yeah.
it could be a few days after that, but I'm hoping that it won't take much longer than that to get all that taken
I'm
care of.
hoping not, because we're going to be getting a phone call
I know.
because
Yeah.
Was,
Schools have
I know.
started.
Yeah.
school has started
I
and it's
know.
a disaster. And
Oh, Monday's the 31st, sorry. Tuesday,
Yeah.
yeah.
Tuesday, yeah.
I mean, we're using
Ideally,
our
yeah.
officers. We have an off-duty schedule. It shouldn't really be that difficult if Pulte's
Mm-hmm.
doing what they're supposed to do. I'm sure we can schedule on our end, but
Mm-hmm.
I definitely want to make sure that sooner rather than later,
Yeah.
we get that in, because that's what we explained to everybody
Yeah.
why we were doing all this. So I don't want to go.
And they have one house right now, and I think they've actually got a second one that just wrapped up too. So they've got a couple houses that are sitting there done that they want to be able to get COs on itself. So I think they're feeling the pressure
Because
there
it
as well.
keeps coming up.
That's good.
Yeah, I know it does. I know it does. Yeah,
There's carrots out there, and I'm glad they're going for them. So
yeah.
Good news,
That's
though.
pretty much it. Yeah.
awesome.
All
Any
right.
other questions from the board?
Yeah.
All right. Thanks for your hard work on this, Kevin. And I want to say thanks to Pulte for kind of being agreeable to these changes. And Matt, yes.
Yeah,
I know, Matt,
absolutely.
you were working
Yeah.
very diligently on this contract as well, so thank
Yeah.
you. It's good
Worked with a lot
teamwork.
of developers, and they're one of the better ones we've had to work with on stuff like this. So,
Yeah.
yeah.
No, they're making it easy, it sounds like,
Mm-hmm.
and that's good to see.
Thanks.
Well, great. Let's see, what else on the agenda? Hey, nothing. So next up, we have a Board of Commissioner meeting on September 8th. Shortly after that, on September 11th, we will be having our 25th annual, or it's kind of our 15th annual, but the 9/11 ceremony recognizing the 25th anniversary of that tragic event will be on Friday, September 11th. So that'll kick off kind of our autumn season of activities with lots of other stuff coming, autumn treasures, fright night, lighting of trees and whatnot. So we have a busy fall and winter ahead of us. Anything else from the board? Comments? All righty. Without further ado, can I get a motion to adjourn?
So moved.
All in favor?
Aye.
See none opposed? This meeting is adjourned. Thank you, thank you. All right.